Hello, everyone. We are Blockchain CoInvestors, the best way to invest in blockchain businesses. The title of today's webinar is What are SPACs? An update on the current market. My name is Mitchell Michigan. I'm Chief of Staff of Blockchain CoInvestors. So nothing in this video should be construed as investment advice. As always, these webinars are purely for educational purposes only. So this is who we are. We are Blockchain CoInvestors, and we operate an integrated investment platform since 2014. There's three main things that we do. The first of which is operate the world's leading blockchain fund of funds. Through these funds, we're investors in more than 40 blockchain venture capital firms and more than 400 crypto projects and blockchain enterprise startups. The second thing we do is co-invest directly onto the cap table into early, mid, and late stage blockchain, Web3, and fintech companies. The last thing we do is that we are early stage token investors. And so through our early stage token fund, which just launched in the fall, we take direct stakes into pre-mainnet launch tokens. Part of our strategy is to be investors in a majority of the blockchain unicorns. And as you can see on the right here, as of year-end 2021, we counted 62 enterprise unicorns. So that's companies with normal equity and debt cap structures. And we are investors in more than 55% of those. And then on the far right side, you'll see that we counted 133 crypto projects with token valuations in excess of $1 billion US. And we are investors in about 40% of those. And because of that broad coverage and ability to invest in unicorns, it's not hard to see why our fund performance has been outstanding. You can see our Fund 1 and Fund 2. The funds for which we have performance data are, as you'll see on the next page, in the top of their class with net TVPIs of 3.6 and 1.7 times TVPI respectively. And you can see here on a blended basis, we are the top performing blockchain fund of funds according to Preqin and PitchBook, and against our peer set of blockchain or of fund of VC funds, we're well and far ahead as the top performing fund as well. We also have a direct co-investment platform, as you heard, really got started in 2019, formalized the program through our AngelList Syndicate and SPV program in 2020, really had our first full year of operation in 2021 and had an outstanding year in terms of investment and capital deployed, and on pace to do even better in 2022. And here's a selected group of some of those direct SPV investments, which are our larger investment vehicles. And you can see here they really span the gamut of blockchain subsectors. We have Uphold, which was a digital wallet. Wire was a payment API. Brex is small business loan financing. Securitize is the digitalization of SEC registered securities. And Infinite World, that's an NFT infrastructure play for the leading brands. And then finally, we do also operate the largest and best capitalized blockchain specific SPAC, which you'll hear about later today in today's webinar. We have an upsized and oversubscribed IPO in November of last year that ended with us placing about $306 million into trust. This vehicle will help a private blockchain company go public later in the year. So if you want to hear more about what's in our portfolio or the types of companies in which we're invested, head to blockchaincoinvestors.com. You can check out our new portfolio section, which allows you to see all the different companies, projects, and funds in which we're investors. And if you would like more detail or diligence on the fund, please email us at ir@blockchaincoinvestors.com, and we'll give you access to our investor access section. So for today's webinar, we'll set the stage with this slide and then move throughout the webinar. And so first, you'll see that special purpose acquisition companies, or SPACs, these are a path for private companies to go public. And the blockchain sector may be positioned for a flurry of SPAC activity due to advantages over traditional financing alternatives, which we'll get into. And then finally, you'll see that a difficult equity market has slowed SPAC IPO and merger market completion, but quality targets are still pricing and actually increasing their valuations, as you'll see at the end of the presentation. So the rest of the webinar will flow as follows. We'll have a recap on what are SPACs and get into a little of the mechanics of a SPAC offering. We'll then talk about why they may be relevant to blockchain and crypto, and then we'll give a status update on the current market. So first, what are SPACs? Well, SPACs are vehicles for private companies to go public. And these really happen in 3 steps. The first of which is a capital raise via traditional IPO, after which you have a publicly traded vehicle without an operating company. The next step is that the SPAC then merges with a private company. This is also known as the de-SPAC event, the consummation of which ends in a new public company, and the SPAC will cease to exist. So let's get into this a little bit on the next slide. So what really happens is that you have a SPAC sponsor, and they're tasked with managing the SPAC. And in this case, the SPAC sponsor goes out and solicits an IPO investment of $200 million from a group of SPAC IPO investors. And they do this in a normal roadshow with a group of banks, a typical IPO process. And the $200 million, unlike in a typical IPO, does not help fuel the operations or research of a company, but rather sits in a trust. And so the SPAC, as you see there, is a publicly traded vehicle, typically on NASDAQ or NYSE, but it has no operations. Part 2 of the transaction then occurs, and the SPAC sponsor identifies a private company that they believe makes an attractive target for the public markets. They inject the $200 million from the trust into the private company. As you'll see there, again, these numbers are illustrative, but are maybe typical for a company of this size. They also will solicit a group of PIPE investors to conduct a PIPE investment. And a PIPE stands for private investment in public equity. And this is really going to depend on the capital needs of the target. So in this case, we're saying the target wants an additional $400 million in primary equity capital to fuel growth in the business. Upon closing, the new company will become a public company, as you'll see there, and will move to a $2 billion post-money equity valuation. The SPAC will then cease to exist. So the public company will take on the private company's name, maybe a new ticker, new board, new management. And the SPAC will essentially go away, being replaced by this new public company. And then you'll see there the resulting pro forma ownerships will be essentially based on the amount of capital contributed. So the private company will retain about 70%. PIPE investors get their pro rata of 20%. The IPO investors, that becomes the new public float of the entity. That's about 10%. And the SPAC sponsor gets about 1 to 2% based on the size of the private company for completing the transaction. So again, these numbers are illustrative. So obviously, if you had a larger PIPE investment, their percentage would go up. If you had a larger IPO investment, that percentage would go up. So why may this be all relevant to blockchain and crypto? Well, you can see here on the page the different options available to companies who wish to access the public markets or have an exit option. So really on the left there, you're going to have the 3 that result in a public market listing. So these are going to be most attractive to high growth tech startups or companies that want to retain a lot of ownership. Obviously, if you sell yourself to a corporate M&A or a PE buyout firm, typically the founders are not going to have control or a high amount of upside if the company continues to grow. So if you're a high growth company that wants to retain upside, at least your shareholders want to retain some upside, you're really looking at the far left 3. Those are also going to create a liquid currency in your stocks. You'll be able to sell efficiently and easily in the public markets. And so really, there's pros and cons to each: the SPAC, the bank-led IPO, which I'm sure you all know of, and the direct listing. Direct listing is essentially just listing your shares on an exchange without raising any capital or curating your shareholder base, like in a bank-led IPO. These are really going to be only available to companies that, 1, don't need capital, and that also have a diverse shareholder base that that are looking to sell, because you need people to start selling to make a market in your stock. And you'll see on the left there, especially on the top left, the SPAC has a number of advantages over the traditional alternatives. Primarily, it's much faster from the target company perspective, 4 to 6 months, because it's essentially a sell-side transaction from that company's perspective. The diligence period can be a bit more flexible and is often shorter. Very important, particularly to some blockchain companies and other high growth companies, that you can continue to raise capital throughout the transaction. So SPACs are often paired with a bridge loan financing or a private capital raise. Similar to a bank-led IPO and a direct listing, the shareholders and founders are going to retain upside and control. The pricing tends to be a little better from the target company perspective, because you're negotiating bilaterally with that sponsor and those PIPE investors. Direct listing, theoretically is perfect because they just start trading in the open market. One of the negatives of the SPAC is that the fees and dilution can be higher, particularly than a direct listing, but maybe on par with the bank-led IPO or slightly higher. and you're not going to as many investors, in that pipe, marketing as you would in a bank-led IPO, where all the traditional long-only investors will play. And as you can see on the bottom, again, there are pros and cons. So companies will pick, a different route essentially for whatever suits their purpose. So you saw SoFi and eToro chosen to go the SPAC route. Bank-led IPO, Facebook and Snapchat, direct listing. We just saw Coinbase do that last year, and notably before Spotify did that as well. So now that you know about the different options that exist, why would a company maybe want to go public? Well, we think there's three main reasons. This is by no means exhaustive, but there's three kind of key reasons. The first is liquidity. So from the shareholder perspective, once you're public, you can obviously sell quickly and efficiently. And, for a lot of these high growth companies, that investors come in very early seed, series A, B, they've marked up their investments a lot in subsequent rounds, but that's unrealized return. So liquidity event allows you to realize that return your capital to your shareholders, maybe to the LPs in your fund. From the company perspective, you have capital. So companies can raise cash very, very efficiently and effectively to invest in their businesses, not only through the SPAC or the bank-led IPO, but once you're public, you typically have cheaper access to debt financing, and you can, of course, raise in the equity markets much more easily. And then finally, prestige. So once a company hits a certain part of its life cycle, public market status may be attractive because it grants legitimacy. And that's because going public requires increased regulatory, shareholder reporting, scrutiny. You have audited financials every year. You have quarterly, shareholder updates. You have independence and governance requirements of the board, to list on NASDAQ or New York Stock Exchange. So companies of a certain, caliber are going to want to go public to gain this legitimacy as well. So now applying this to blockchain, let's see how, blockchain scores. So on the investor side, we see that investors have been investing heavily in the space, and that's been ramping up, particularly in recent years. 2021 was, obviously, as you can see on the chart on the left there, a record year for blockchain investment. And, as we see on the next slide, this investing has tended to increase both in valuation and size, but also in the stage. So we're having larger deals happening later. So again, those investors that got in early, they're marking up their investments in those later rounds. The valuations are increasing. Their funds are reporting, higher returns, but not a lot of those funds have had the chance yet to realize those investments, to sell some of those positions, to return capital to their LPs. And so from the investor side, we think blockchain, is likely positioned to have a lot of pressure from the investor side to access the public markets or some of those liquidity events such that they can return capital to their shareholders. And on the company side, we see that, the caliber and maturity of company is also, increasing rapidly. So whereas in 2019, there were about 15 blockchain unicorns, now there's somewhere between 60 and 70. And as you'll see there, a number have chosen to access the public markets already. But really, there's a buildup in companies that are private with multi-billion-dollar equity valuations that are going to look to, one, have much greater capital needs that they'll be able to get in a public market listing, or once they're public in the debt capital markets or something similar. And then also a lot of those companies are going to look to get that prestige granted and that legitimacy granted from a public market listing as well. So really, when you look at blockchain as a whole, both from the investor side, but also from the company side, we think there's a confluence of events that are going to force a lot of these, not force, but suggest a lot of these companies to access the public markets in the short to medium term. And, as you've seen, the bank-led IPO, direct listing, and in particular the SPAC are all going to provide that route. So what does the current market look like? Well, a lot of geopolitical instability in the first part of this year and high inflation across the Western world has created some choppy equity markets. So we've seen, to mid-March about the S&P 500 fall, call it 5.5%, with large amounts of volatility. We've also seen inflation across the Western world range from 4 to 7%, and gasoline prices in the US, go above $6 a gallon in some places. And then obviously you have, massive geopolitical conflict in Eastern Europe as well. And so this kind of choppy, uncertain, unstable equity markets has indeed slowed the SPAC IPO market and then also the SPAC merger market. So you can see here that, at the beginning of 2021, we had a massive boom in SPAC IPO issuance and announced merger deals. That slowed, in the spring and summer, but was really starting to pick back up at the end of last year. But as you can see on the right-hand side of both pages, of both charts, that February and March, really the activity's just fallen off. And by the way, this pairs pretty equally to the regular IPO market and the direct listing market, which has slowed significantly, as companies are choosing to wait on the sidelines and kind of see what happens in the equity markets. In addition, we have because of that boom in late 2020, early 2021, we have a glut of SPACs searching. So you can see on the top right there that we have about 440 SPACs searching for a target. That's SPACs that have already IPO'd but have not yet found a target. They're still kind of in that step 2 of the SPAC transaction. And on the bottom left there, you'll see that a lot of those SPACs, because they IPO'd in the boom, you can see on the top there, 314 SPAC IPOs in Q1 of 2021. Those have, less than a year. Most of those, you can see on the bottom there, have less than a year of term left, because SPACs typically carry a term by which they have to complete the acquisition. And so that kind of pressure and the glut of SPACs out there is going to weigh on new SPAC IPO issuance, and also, announced mergers. And as you can see on the bottom right there, that for the SPACs which have announced deals, so there's about 105 SPACs which have IPO'd but announced a deal which is not yet closed. About 95% of those are trading below $10.50. That $10 share level, that's an important number for SPACs, as the trust is, backed at $10 a share. The book value per share is about $10. So again, from a new IPO issuance perspective, why would you buy a unproven SPAC without an announced target at $10 a share when you can buy a SPAC that has announced a target, the target's known, to right around that $10 share well. So those trading levels will, likely serve to constrain further SPAC IPO issuance as well. But, we think it's important to note the kind of deal specific nature of SPAC transactions, and that quality offerings, still are performing quite successfully. And a good example of that is Circle. So Circle is a very important company to the blockchain and crypto ecosystem by virtue of them managing USDC, a dollar denominated stablecoin. They manage that in consortium with Coinbase. And so, applying some of those metrics we talked about to Circle, they had 9 private founding rounds, by mid last year, including the latest round at a massive valuation of $4 billion, raising $440 million. So again, from that investor perspective, those investors who got into those early rounds have clearly marked up their investment significantly in terms of unrealized gain. But you can imagine that they were pressuring the management and very eager to have a liquidity event such that they could realize some of that gain. If you also look at their projected revenue growth from 2021 to 2023, obviously a massive CAGR of 180%. So they're going to have capital needs from the company side. And then also in terms of legitimacy, the fact that they manage USDC, a going public event for Circle in which, get the blessing of the SEC to go public. They have audited financials, they have quarterly reporting, that legitimacy would also potentially help, their product USDC in the market by making USDC seem more legitimate. So you can see kind of the perfect storm by which, Circle would choose to access the public markets. So because of that, we saw that in December of 2020, Concord Acquisition Corp did a $276 million IPO, again, without announcing who their target was. So we didn't know who the target was at the time. But in July of 2021, the merger was announced with Circle, where they were injecting that capital from the trust and the IPO into Circle, alongside, very interestingly, $415 million in PIPE investment. And if you look at some of those PIPE investors, we have very well-regarded long onlys of Fidelity, Marshall Wace, and Adage. We also have a very notable hedge fund Third Point in there, so a very kind of prestigious group of investors coming in. And then, should the merger had closed in Q4 of last year, it would have been done at a $4.5 billion post-money equity valuation, and the existing shareholders retaining about 86% of the company. However, as you'll note, that transaction did not close, and some people may have seen that as a negative sign. But, very interestingly, in February of this year, they announced a revised transaction. And so what had happened is essentially, and you'll see on the top left there, that the USDC market cap growth from Q2 21, when the initial deal had been struck, that market cap was at about 22 billion. And by Q1 of this year, that had increased to 52 billion. So more than doubling in their USDC market cap growth. And on the bottom there, you'll see that caused them to revise their revenue and EBITDA predictions. So their revenue, you have noticed 2 slides ago that in 2023 was about 900 million. And then now they've upscaled those projections to about 2.6 billion. So really, really massive growth. And so because of that, they re-announced the merger terms in February of just about a month ago. And that included an increased valuation from 4.5 billion to 9 billion post-money equity value, and included, as you'll see on the bottom there, a earnout structure by which if certain share price metrics were hit, then the existing shareholders would get additional value, up to 20% of the deal value. So just a massive earnout. So this just really reflects that. And by the way, this is now expected to close with following the new agreement, in the second half, early second half of 2022. So really just goes to show that even in a down market, in the middle of a very volatile equity market time, and call it mid-February, with an inflation backdrop and the Federal Reserve potentially raising rates, that the deal specifics and idiosyncrasies of each company do matter, and that in this case, a very high quality company with very promising growth was able to actually renegotiate their deal in their favor to increase their valuation, and we would expect this to close shortly thereafter. So just to recap what we've gone over today: special purpose acquisition companies. These are a path for private companies to go public. And as you've seen, the blockchain sector may be positioned for a flurry of SPAC activity due to advantages over traditional financing alternatives. And finally, although there is a difficult equity market backdrop, and this has slowed the SPAC IPO and merger markets, we still are seeing quality targets pricing, and in fact, sometimes increasing their valuations in SPAC transactions. So we are Blockchain CoInvestors, the best way to invest in blockchain businesses. Thank you so much for joining today's webinar, and we hope you join us again for the next one.